Hey everyone, hope you all are doing well. In today's video, we are going to dive deep into the world of smart beta funds and try to understand how these funds are able to beat the traditional index fund returns using factors. At the end of this video, I'll also be sharing one smart beta fund where I'll be parking a portion of my portfolio. In case you are new here, then hi, I'm Harshdeep Srivastav, a corporate finance graduate, an ex-investment banker, and now an entrepreneur. If you're someone who's really serious about building long-term sustainable wealth, then do consider subscribing to my channel. So without any further ado, let's get started. What are smart beta funds? So traditional index funds assign weights to individual stocks in proportion to their weightage in the benchmark index. This is the reason when you invest in a Nifty 50 index fund, a large portion of your money gets invested into stocks like Reliance Industries and HDFC Bank because they have a high weightage in the Nifty 50 index. The issue here is that it is not necessary that a stock with a higher market cap would also yield a higher return. In order to not lose out on the gains that come from comparatively smaller market cap stocks, smart beta funds came into the picture. Interestingly, smart beta funds actually use a balanced approach between passive and active investing. Smart beta funds are designed to outperform the index funds by using an additional rules-based strategy layer. The stock selection in smart beta funds is done by using specific factors like momentum, alpha, low volatility, quality, value, etc. This is the reason why smart beta investing is also sometimes referred to as factor investing. As you can see on your screen, this table shows the CAGR returns of traditional broad market index funds, that is Nifty 50 and Nifty 200, in comparison to smart beta funds with different factors in focus. Historically, the highest return has been given by momentum funds, followed by alpha low volatility funds, which are basically multi-factor funds. Globally, smart beta funds have already gained a lot of popularity and more than $1 trillion worth of investments have been made in them. In India, smart beta funds are still in their early stages, with most funds yet to complete 3 years since their launch. However, given their widespread success in developed countries, this approach is expected to flourish in India as well. Just so you know, even larger entities such as LIC mutual funds are betting on smart beta fund schemes for growth, as the ETF inflows have hit a whopping 19,000 crores in April 2025. Now, to understand things better, let's take a look at how each of the factors helps generate alpha over the index returns. Smart beta funds that are based on value prioritize stocks that are trading at a discount compared to their intrinsic value. Usually, the metrics used for this strategy is price to equity, price to book value, and price to sales. Now, smart beta funds that are based on quality prioritize stocks that have good fundamentals, which means they should have high return on equity, low leverage, stable increasing earnings, and a healthy cash flow. Funds that are based on momentum work on the ideology that stocks with recent strong performance will continue to deliver good returns in the future as well. Here, the major metrics used is the trend in stock price performance. Now, as the name itself suggests, funds that are based on low volatility factor invest in stocks with low volatility, thereby safeguarding the portfolio during downturns in the stock market. The major metrics used for this factor are beta and standard deviation. Lastly, funds that are based on alpha invest in stocks that have given higher return in the past compared to the average index portfolio. For this, the main metrics used is risk-adjusted return relative to the market index return. For your reference, here are some examples of smart beta funds that are based on the aforementioned factors. From time to time, typically every 6 months, smart beta funds are rebalanced to align with the chosen factor to adjust for the changes that happen in the market. Since these funds are rules and algorithm based, they carry a lower management fee than actively managed funds and so are cost effective. At the same time, since no element of human bias is involved for stock selection, it eliminates the risk of subjectivity and human emotions. Now, definitely, smart beta funds bring the best of both passively and actively managed funds, but that does not make them risk-free. See, sometimes a fund may focus heavily on just one factor, which may lead to over-concentration and high risk if the factor does not perform well. For example, in a bear market, momentum funds tend to underperform, and so you are left with lower than expected returns from your investment. There is also a backtest bias, which means the returns promised are based on historical data, and so expecting the same returns in the future may sometimes lead to disappointment if the markets play out differently. It is due to these risks, it is important to have a cautious approach when investing in smart beta funds. One should typically restrict exposure to these funds to 20% of their entire portfolio and preferably start with an allocation of only 5 to 10%. So now that you are well aware about what smart beta funds are and how they work, let me share with you some important data which might help you to choose the best smart beta fund. If you're still watching this video, then do subscribe to this channel as a lot of effort goes into curating these videos. Now, if you look at the factor success rate in this chart, then clearly Nifty 200 momentum 30, Nifty 50 value 20 and Nifty 100 low volatility 30 have beaten the parent index most number of times. If you take a look at the last 5-year CAGR return of these three smart beta indices, then you can clearly see that Nifty 200 momentum 30 has given a return of 23.82%, Nifty 50 value 20 has given a return of 23.87% and Nifty 100 low volatility 30 has given a return of 21.39%. Overall, from a return perspective, clearly single factor indices have given the highest return. But there is a caveat here. In bear markets, these funds will fall in value with the same intensity with which they rise. This is where the role of multi-factor indices comes into the picture. For example, Nifty Alpha Low Volatility 30 gives 50% importance to alpha, that is stocks that have potential to outperform the market, and 50% importance to low volatility, that is stocks that are comparatively stable. In a way, this multi-factor index uses a balanced approach of growth and stability. Return-wise, it has given a respectable 5-year CAGR return of 20.98%. Now, this is not an investment recommendation, but ideally, an aggressive investor with long-term horizon should opt for a single factor index such as the Nifty 200 Momentum 30, and a risk-averse investor should go for a multi-factor index such as Nifty Alpha Low Volatility 30. But one should have the know-how that when you invest in multi-factor index, you will get lower returns because of prioritizing stability over high-risk growth. I personally am a high-risk investor, and so I'll be parking some portion of my portfolio in ICICI Prudential Nifty 200 Momentum 30 Index Fund. In nutshell, smart beta funds play a valuable role in a diversified portfolio, especially for investors who are willing to explore beyond the traditional index funds. I hope that this video gave you valuable insights on smart beta funds, and you now have the know-how to self-evaluate which smart beta fund will suit your risk appetite. Thank you so much for watching. Like the video, hit that subscribe button and stay tuned for my next video.